Good day, folks. Thanks for taking time out of your schedule today. Hopefully you will find this information valuable. What we're going to do today is, again, as Dan said, talk about some of the fundamentals going on up in your region. Let's move into what we will talk about today. We're going to update natural gas basis. That's the differential between your region and the Henry Hub. We're going to talk about natural gas commodity pricing, which is priced specifically at the Henry Hub in Louisiana. We're going to bring in electricity. You might wonder why we're going to bring in electricity here, because this really is primarily focused on gas. But I'm going to talk about it with an eye towards its impact on natural gas, and then we'll look at weather always being a wild card, as we learned from last year's winter events. So with that, let's move forward. Let's look at natural gas basis and some of the constraints that are going on in the New England market. Basically, what happened as the LNG market around the world soared from $4 up to our countries south of us, i.e. Mexico and Brazil, paying $16, upwards of $18 a decatherm. The LNG supply that used to come in to help in the winter is no longer there. Connecticut is there, as you see in the top right. But basically, you have Canadian supplies coming in from the top left. In the north into the region, you have U.S. supplies coming in from that Marcellus. See the star and all the pipelines down specifically around your state. But the most critical junction is this. It's constrained in the winter from that Canadian U.S. supplies. In the peak winter day, LNG was able to supply upwards of about 1 million decatherms a day of that additional gas supply that was required. And unfortunately, Connecticut is supplying anywhere between 300 to 600,000 decatherms a day, maybe even close to 700 on a peak day. The bottom line is that gas is coming in at a very, very expensive price. So Connecticut is assisting in some of the offset to the high prices, but nonetheless, it remains a gas-constrained area, a capacity constraint. LNG is not so much constrained. The facilities are there. It's the price constraint on LNG, and it is pipeline constraint coming from Canada and the U.S. supply. So that's really been causing the big issues. Now, if LNG prices around the world were to change, certainly that could change the dynamics of what we see now. But for the current state and looking forward out the curve, LNG prices are high and forecasted to at least stay above U.S. prices pretty significantly. So what may help to alleviate some of the basis constraints in your area is Algonquin Incremental Market Project, AIM, starting in 2016. This market really will expand the production by about 350,000 decatherms a day. As I said, you're saying, well, Tim, that doesn't really help us a whole lot because I need 1 million, I get 600, that's very high price, or 650, I add another 3.5, I got my 1 million, but I'm still going to be working with what appears to be higher price gas. That is a potential. Yes, that is a potential, but the bottom line is that this excess gas will certainly help offset some of the issues that are occurring this past winter. The oil reliability program, when we get to electricity, I'll talk about helping to offset some of the gas issues also, but nonetheless, as again, you'll see this in a slide. Let me show you what is the price impact of this extra capacity that will be coming into your area. So summer gas basis, this is Algonquin. Summer 2015 is the blue. Summer 2016 is the red. And basically, I just want you to look at the direction because absolute prices, this is paper markets. It's not weighted at all for any kind of physical delivery. It has no load weighting in it whatsoever. It's really there for you just to see the general direction. So you may ask yourself, okay, well, what caused the spike? Well, if you look at the polar vortex back in January, you see a spike, and then it just continues to stay cold. Right? So back in March, you see some more spikes and further out the curve. And there was uncertainty. that was a uncertainty concern, an uncertainty risk there that storage levels would be constrained moving into this season and possibly into the next few years. But as you can see, prices now have declined to where they were at least near the beginning of March. They're not back down to the levels pre-vortex, but they're, at least for the 2016, a lot closer. So the summertime basis is being impacted by the fact that maybe some of the hype is out of the market. It's also being impacted by something I'm going to show you in the production section when we talk about the commodity section. Unfortunately, this is the Algonquin winter basis, the 14-15 upcoming winter. Blue, 15-16, red, and then the green, 16-17. And as you can see, there is the impact of the expansion project. Where the current winter has set new highs, at least the 15 and 16 and 16, 17 have not reached the highs that were set earlier this year. Again, the concern is that another cold winter could lead to elevated pricing in your area. Again, this is not representative. It's not weight loaded for any kind of, it's not loaded for any kind of weighted average for any kind of load profile. It has nothing really to do with the paper markets. Some of the specific months in the paper markets are much higher than this level you see here. It's really just a point to give you a general direction. The other concern may be, and when I get to the electricity section, is that a winter reliability program this year, which the ISO New England relied on oil to allow oil-fired generation to allow gas-fired generators to run. Those prices were substantially, even with that oil program, the prices were substantially higher for gas than the market anticipated, and that's possibly what's being reflected in the 14-15 winter right here. But note that we do see a decline in the capacity as we move out into that 16 for the AIM incremental market project. Switch over to commodity. Commodity down in the Henry Hub as we discussed. So it's something we don't want to take our eyes off of, but let's look at why the commodity pricing might be doing what it's doing on the New York Mercantile Steel Exchange, which again prices down in Louisiana. This is current in Northeast and U.S. production. This is from Bentech Energy, which tracks and/or models real-time gas flows. The top left is the Northeast, and as you can see, production in the Northeast is a record, and I'm going to help put this in perspective for you. Marcellus production alone right now is about 30% or 2,530,000 decatherms higher year over year. Marcellus production is about 16% of total U.S. production. When I take the total Northeast production, it's about 4 million decatherms a day higher year over year. In total Northeast production using May month to date data on production, this is dry gas, using dry gas, about 22%. So the Northeast is approximately 22% of all the dry gas production in the United States. So pretty astounding. Drilling costs down in that area, and I'm moving to the right, Southeast, you can see that blue line going up. Drilling costs are $450 plus there. If you remember earlier this year, we've seen prices well above $450 allow producers down in that area to hedge forward, i.e. lock in production margins. Down in the West, we see a little bit of a dip, but a lot of that had to do with maintenance programs. But the West has been pretty consistent. Overall, in the lower right, we just set a record again by Bentech Energy. And Bentech Energy, again, is your own government. The Energy Information Administration purchases their data, uses their data. And they pretty much confirm, the EIA confirms what Bentech says. The EIA and Bentech will always recalibrate the EIA data. But if I tell you that production is a record now, it's high probability that the EIA will confirm that 2 months from now. But as you can see, we have record in the Northeast. We have gains in the South. Total U.S. record increasing. That impact is being seen in this price curve. So each dot, starting from left to right, the first dot there is June 2014. That is the current spot contract. We move out through the top there, that peak around $5 was the January of 2015. And you can see the black line is where when I priced this out on January 6th, and it's not really changed significantly. That's why I didn't really change the graph. It would look the same the dots would have been about the same difference. From a year ago with the blue line, same contracts, you can see we're substantially higher. Big reason of that is, as we move through April to October, is the storage deficit, the big hole in the ground. We have to get gas back in the ground for next winter. That is supporting prices. The market is concerned that we won't get enough gas in the ground for next winter. And even if we do, the amount of gas that's required to fill to adequate levels, and the market right now believes that adequate levels will be around 3,500 BCF, and there's certainly a camp that's leaning that we're not going to make that number, implies gas-on-gas competition. If it were to get hot, utilities in this area specifically, which control about 80% of all storage capacity, are going to eject regardless of the price. If it gets hot, we need electrons for air conditioners, and so we could have this gas-on-gas competition where utilities continue to buy at higher prices, and energy generation continues to buy in order for us to have our air conditioning. As we move through the winter, we still have a risk premium. That risk premium is partly due to weather, even if there was adequate storage, or the uncertainty that storage is not there. But things change. The dynamic changes. As we move into next April through October, that next summer injection season, the black line again is from May 6th. We're slightly higher, so you can start to see the psychology changing a little bit. Prices are a little bit higher than they were this time last year. But as we move through next winter, at that 420, we're still lower than we were this time last year. And as we go out the price curve through April 2017, the black line, March 6th, still lower. My opinion is that this hedge, frac, and flow model As I discussed, drilling costs at $4.50, we can hedge. We go out, we drill, we frack, and we flow. I think this is having a big impact on the future because demand, I can tell you right now, demand certainly is expected to increase over these periods, but nonetheless, the market believes that supply will match that. It's the uncertainty in front of the market that's really driving this. So from a commodity perspective, you have to ask yourself, I know the basis is going down in the future, and it may go down even further, and I'll talk about that in the electricity section, why that might happen, but you can see these prices are pretty dramatic declines from where we're at currently. And when I take the basis in some of the regions outside of your area in New England, they're negative in some cases, and they're sitting right on top of coal to gas economics. So the downside for the commodity may be limited as we move out in the future, and demand could be the big surprise. Just like demand for power and gas was a big surprise this winter, even overall industrial transportation exports to Mexico and Canada, LNG exports, the market could get that wrong. So I did want to bring up the commodity and just say let's not take our eye off the ball on commodity. We know where basis is right now. It's potentially the basis could go down, but it's also potential that the commodity could go up. Let's switch over to electricity. And as I mentioned, I would discuss electricity as it relates to what I believe its impact might be on natural gas. Here is a slide from the most recent auction that occurred for generation capacity in ISO New England. And what I did was highlight for you from the auctions that started in 2010-11 all the way out to the most recent one. There was a surplus. Those boxes were 1772 megawatt surplus, 475, 5,000 megawatts, and then gradually, slowly but surely, with Vermont Yankee going down, Brayton's Point coal plant going down, Salem taking down a coal plant. They will replace it with gas, but as you can see, quite quickly, New England has gone from a surplus of capacity to a deficit, right? And you say, well, what does that have to do with gas? Well, this is kind of what it has to do with gas. Capacity prices reflect higher generation costs. We're going to lose a nuclear plant. We're going to lose 2 coal plants, get 1 replaced with gas. Nonetheless, the market now is trying to incentivize plants to come in. And the plants that will come into that area more than likely will be gas. Additionally, on not what I would say extreme peak days like we had in the winter, but when we get to peak days, gas is anywhere between 50 to 55% of total generation, gas demand of total generation in New England. So if we were to take these coal units off, these nuclear units off, and replace 3 units with 1 unit of gas, it may mean the gas demand for the energy portion, where we're putting in fossil fuels into the plant, around the clock, the RTC stands for around the clock, gas demand may move higher. So, we're looking at the situation, we're seeing these plants go offline. What may replace them is gas. We had an oil reliability program. That reliability program probably will continue to be, it's definitely going to be in place from 15, 16. It may be in place 16, 17. We'll see how that goes. What might offset this, though? I wanted to bring something just to throw out to you. It might change the psychology of the market sooner rather than later, and that is state renewable portfolio standards. All right, one thing that may take the edge off of some of this loss of nuclear and loss of coal in your state, specifically Connecticut, may be the portfolio standards. You're second only after New York, which is very aggressive. You can see the New York, they're 29% by 2015, a very aggressive goal. In the Northeast, though, Connecticut, 27% by 2020. Now you say 2020 is a long way away from 2014. Yes, it is, but I can tell you right now that New York aggressively moved their portfolio standards forward, and it's quite possible that other states do that also. I'm not saying that this is going to happen, but I did want to bring it to your attention that having the highest price energy in the United States right now draws attention, and attention typically can imply action. So we'll keep our fingers crossed that the market looks at this and comes up with a solution that is workable for all groups, that's producers and end users. Let's look at weather one last time before we leave. Some of the things that are going on with the weather short term is the same kind of psychology that's going to be used for this next winter. Right now, this is the forecast for the upcoming April through June. But this is what an April through June El Nino forecast looks like. Hot in the west, and as you can see the fires and everything that's going on, the droughts out in the west, and cooler in the east. So far, through April and May, this is what the United States is looking closer to this forecast than it is to this forecast. Why I bring this up is this is going to help alleviate some of the issues in the marketplace right now. And let's go back real quick to show you how the El Nino might be Okay, we have this right here. We have this gas production we talked about. But how might the El Nino be helping to alleviate some of the production? If the market believes that gas production is going to increase, and we do have milder summers going forward, or even summers that are normal, you can see that the market looks at this in the summertime and says, hey, you know what, we have enough gas coming out of the Marcellus and Utica right now that even in a hot summer, we can support lower basis markets than we've seen back in the early part of 2014. So as we move forward, the question may be, well, what's the weather going to be? Unfortunately, this past winter, and even though everything is looking like this right now for this term, this past winter highlighted that getting it wrong could be very wrong. So if I leave you with anything, it's this. Let's go through the summary of price outlook. We have constrained access to shale gas, all right, till 2016, an AIM incremental project. I will tell you also the Constitution pipeline is coming in. It's going to be bringing gas out of the dry region of northeastern Pennsylvania, Susquehanna, Tioga, Brantford counties, dropping into Iroquois at Wright and into Tennessee gas. That may also help Connecticut to some degree. So there is AIM, but there's also Constitution, which may help. Those long-term commodity discounts I mentioned before, lower total energy costs. Again, let's not take our eyes off the commodity because, listen, we got production wrong, myself included, many years ago. It's quite possible that we can get demand wrong. And if demand around the Henry Hub starts increasing, where the biggest growth in demand in the United States over the next 5 years is probably going to come around that region, it could raise those commodity costs we talked about, even if you were to see substantial basis declines. Power plant retirements, as I mentioned, may increase gas-fired demand, but renewables may limit gas-fired generation, as we talked about. That weather risk premium may only diminish closer in. It's possible that if we have a mild winter again, some of the numbers you're seeing right now would look almost absurd. Unfortunately, you may be sitting in December 25th for a forecast that says it's going to be a very mild January. We're not saying that that's not what you do, but the weather risk premiums this past winter added quite a scare and shock to the market. Our belief is that energy budget strategy, because of prices moving so rapidly, in fact, the basis markets right now are moving to a much larger degree than the commodity markets. We can see in some areas we've seen dollar increases in winter basis markets occur over a 7-day period where the NYMEX commodity might have increased maybe 20 cents or decreased 20 cents. So we believe that the ability to act quickly if gas and power prices decline or increase above budget targets is going to be very critical to helping with your budget as you move forward. And with that, I'll take any questions. One question that came in very interesting, and it's along the lines of a California question. Somebody asked if what is my estimate of what conservation might do or any kind of efficiency gains might do to power. I can tell you right now that in California, if you're installing in a building right now, they're going to try to enforce in the rules for building that they break out 3 separate panels for your HVAC, for your lighting, for other parts of your company, so that they can see where the demand's coming from, so that they can adjust that way. So it's going to be interesting. I can't answer that question, but certainly, again, high prices lead to a different way of thinking, and conservation and energy efficiency certainly could be a wild card that gets built into new builds and or even to existing facilities that could have a substantial change in how energy, maybe specifically electricity, but even gas, is utilized, and that could be another bearish factor as we move forward in time. All right, folks, we won't keep you any longer. There is no other questions that have been coming in. Excuse me, my apologies. Do high drilling costs affect more the commodity price or the basis? High drilling costs let's go down to the south and at Haynesville, where we discussed, and I showed you that 450, they affect more the commodity than anything, because most of the pipeline basis is already built out there. So excuse me, most of the pipelines are already built down there, so building an extra network to get to that gas is not a substantial cost, but as it relates to the Northeast, we're seeing that lower drilling costs are being offset by higher gathering and transportation costs. So down south, it probably affects the commodity more. You have the higher prices required to get that gas out of the ground. In the Northeast, where drilling costs are substantially low, you have high liquids output. To put in perspective, drilling in the northeastern Pennsylvania might require $3.50 to $4 gas prices. In the southwestern part of Pennsylvania or in West Virginia, where you have natural gas liquids, that's ethanes and propanes and pentanes, high carbons, high cost, the difference can be about $2. It can break even at $2 down. So you can see that as I move from one area to the other, my commodity price goes down, but the cost of getting that gas to market, i.e. the basis, might have to increase because that's what's going to be required to get it from that area where there's not the infrastructure that you've seen in the South. I hope that answers your question. Any other questions, folks? Well, with that, then, we will say thank you for your time. We hope to keep this brief because we know your day is busy. We thank you for joining us. If there are any other questions post this, please reach out to your sales rep and or myself or both of us, and we will try to answer your questions as effectively as possible. I believe that this copy of this will be going on, posted
Sure
on
thing. Yep.
Be posted. Go ahead.
Yeah. So we'll be collecting this presentation. We'll distribute out the slide deck for you guys, and then also we'll provide a recording of this actual presentation as well. As Tim said, thank you very much. We appreciate you attending today, and we hope you have a great day.